I would like to congratulate everyone on being here today. Participation today shows you're serious about your contribution to the industry and learning new skills and information to support your clients. A few ground rules before we get started. This session is being recorded and a replay will be available in the toolbox along with the slides. I will have phones muted. Please give us your full attention and avoid being distracted by other work. Any questions you have for our speakers, please add to the chat box, and I will share them after the presentation during the Q&A at the end. The slides will be available after this call, and I can email those to you as well. Any further questions or information can be directed to Tyson Schwartz and Dennis, who we're happy to have present today. He's the Director of Schwab ETF Product Management. Dennis Hudachek, supporting in his role, responsible for product management of Schwab's index mutual funds and ETFs. He provides analysis around product construction and attributes for proprietary and third-party funds. He joined Schwab back in March of 2015 from ETFs.com, where he spent 5 years as a senior ETF analyst, responsible for the creation of the firm's ETF analytics and classification tools. In this role, he helped build the firm's ETF scoring system and supported the publication and sales team with ETF education, research reports, and white papers. Prior to that, he spent 6 years in the global management, wealth management division at Merrill Lynch, Bank of America. He holds a bachelor's degree of arts and economics from the University of California, Davis. And Tyson is here as well to support Dennis. And Dennis, you can go ahead and kick it off. Hopefully everybody can see the screen. Thank you for being here.
Great, thank you, Tina. And good morning to everyone on the call, and thank you for joining today. As Tyson may have mentioned, we currently have 2 reports that we will be covering today. These are reports that we have created called the ETF Industry Highlights, as well as a second report that we call the Strategic Beta Tracker. And really the reason why we created these reports is to really help a lot of our clients and other readers to stay on top of basically what's going on in the ETF industry, to stay on top of ETF industry news and trends in terms of assets and flows, launches, new filings, or sometimes some significant changes that are going on in some key ETFs out there. And the idea was to kind of simplify and consolidate all this information into a very short, straightforward report. And the idea is basically, we know that a lot of you are bombarded with a lot of material. There's going to be a lot of reading. So the point, our goal is to kind of move away from, all the text, right? I know that time is limited. It's very difficult to read reports. So our goal was to kind of present the highlights where it goes away from, writing paragraphs and paragraphs, but basically you can see in charts and graphs what's going on. And the idea is really, again, to, just if you have 5 minutes, either the way I kind of like to look at this is, I got 5 minutes or 5-10 minutes going back home on the train before I have to pick up my kids. A perfect time to just pull this up and kind of get an idea of what's going on, to just kind of stay on top of some significant news here. And the ETF highlights is more of an industry-wide report, and that we produce on a monthly basis. And the Strategic Beta Tracker, the second report that I'll cover after this report, that's produced on a quarterly basis. And I know some of you already receive this report, but for those of you who currently are not receiving it or have not seen it, we hope that this could be very helpful in kind of going over exactly what the content of the report covers. So with that said, I'm going to just dive into the report. I'm going to go through basically page by page of the report, and at this point cover kind of what happened in 2019, right? What are some of the key trends in big news that we saw in 2019 in the ETF industry? And we'll also cover flows in assets, issuer leaderboards, and whatnot. So at the beginning of the first page of the report is always basically, let's just say, the 5 or 6 main takeaways for the month, right? That we feel it's probably the most relevant. And being that this is, the year-end report for December, what we've done too is we've also added a new page, which is notable in 2019. So these are kind of like the 6 big themes that, as we would say, that kind of we think is really important to take away from 2019. Now, the report primarily focuses on assets and flows. So I'll dive into that a little bit later because there's a lot of important things to cover there. But while we're on this page, there's 3 kind of main themes that I think it would be really good for the listeners here to take away today in terms of what happened in 2019. First, regulatory, some developments on the regulatory side. Number 2, fee compression. And number 3, ESG. So those are kind of big themes that we think kind of it'd be good to kind of focus on in terms of what really transpired in 2019. So let's just start out really quick with the regulatory side. And 2 big news on that front. First and foremost, the approval of the ETF rule by the SEC. And what that, in a nutshell, what that does here is it actually allows issuers now to launch products and file for products without filing for exemptive relief. Now, in the past, issuers that wanted to launch an ETF would have to file an exemptive relief filing with the SEC, and that's no longer the case. So really what it does is it kind of makes it a lot easier to launch ETFs. It kind of makes the process more efficient and also less costly for issuers to launch new ETFs. And the second component of the ETF rule is really in terms of customizing the basket. As some of you may know, the authorized participant, the ETF issuer provides securities to the authorized participant, who in turn goes and sells those securities on the market. And what the ETF rule has done is to really kind of allow issuers to be able to customize the securities that they would deliver to the APs. And really, again, what that's done is to kind of level the playing field, because in the past, various issuers from Vanguard to iShares to State Street, they had exemptive reliefs that were quite different from exemptive reliefs granted to new issuers. And some would say that they had an advantage in terms of the types of securities they were able to deliver. So again, what that's really done is level the playing field for all issuers out there. So again, that's number 1 on the regulatory side that I think is an important takeaway. Number 2 is the approval of non-transparent active ETFs. Presidian was the first to get approval, and the brand name for that is Active Shares. And the Active Shares filing has actually been in the works now for years. And finally, in 2019, the SEC has approved this structure, along with other structures from issuers such as Fidelity, T. Rowe Price, NYSE. So again, what this is going to enable ETF issuers to do is to launch ETFs without having to disclose their holdings on a daily basis. And what's so significant about this is one of the things that's been really holding back active issuers from launching ETFs is this idea that currently or previously under the current rules of an ETF, the issuer actually has to disclose the holdings on a daily basis. And obviously a lot of active managers don't like that, because they're basically saying, we don't want to kind of share the secret sauce. We don't want to share our holdings. We're concerned about people maybe front running if we're showing our holdings. So what this does is kind of takes that component out of the ETF launch. So what we can probably expect in 2020 is we're probably going to start to see a lot more active shops launch ETFs. And what that means for the multi-factor ETF front, that's to be seen. I think previously what had been happening is because a lot of these active issuers weren't able to launch non-transparent active ETFs, their kind of entry into the ETF space has been through strategic beta, right? A lot of these multi-factor index products a lot of them based on some of their active strategies, but that's kind of been where a lot of the proliferation has been with this new approval for active shares and some of these other non-transparent active structures. We'll see what happens in that landscape, but we do expect to see a lot more active managers launching ETFs in the coming year or two. So that's the regulatory front. Now on the fee compression front, we've actually seen some big developments as well. Some highlights there. We've had some pretty big expense ratio cuts throughout the year from iShares, from State Street. Vanguard's actually been very aggressive recently, and so has Schwab. Schwab has actually lowered expense ratios on quite a few of its funds as well. So again, that in turn, it's causing somewhat of a fee compression where fees are coming down, which is generally good, really, for the end investor out there. We've also had a couple of launches that's contributed to fee compression. We had our first U.S. large cap ETF, as you see in the highlights here, launched at 2 basis points. Previously, the low was 3 basis points, but now JP Morgan has launched a U.S. large cap weighted ETF at 2 basis points. We've also had newcomer SoFi debut a couple of ETFs at 0 OER, although that's a result of fee waivers. But nonetheless, we did have a couple of initial 0 OER or 0 expense ratio ETF launches. We've also had, as many of you I'm sure have seen in all the commercials, there's been headline news, 0 trading commissions on multiple different brokerages. Charles Schwab announced the elimination of them initially. And then from there, firms like TD Ameritrade, E-Trade, Fidelity, they've all kind of followed suit. And now trading is basically you can trade stocks and pretty much ETFs for 0 commissions. So again, that's a little different from the expense ratio reduction, but at the end of the day, that's fee compression in the sense that the overall cost to the end investor or the client that's actually purchasing these or the advisor, commissions are now eliminated. So that's great news for the industry as a whole. And then finally, I think fee compression, one more thing I'd mention is ESG. So we've had a couple of ESG launches. There's been a lot of fee compression in the ESG space. And there's a couple of launches this year, high profile launches, and they priced at 10 basis points. So that significantly kind of undercut some of these other lower cost issuers. Vanguard had launched an ESG product last year at 11 basis points, and now these products have come in at 10. We expect that fee compression to continue in 2020, and ESG focused ETFs will likely continue to become cheaper for the investor in terms of overall holding costs. So that basically opens up to, I think, the third big theme for this year is really the kind of, I'd say the birth of ESG in the U.S. markets. Let's just put it that way. 2019 was really the year where ESG investing, we believe, kind of went mainstream, at least in the United States. In Europe, it's been going on now for several years. But as far as in the U.S., we've had a lot of launches. We had 21 new launches focused on these types of ESG strategies. And just to give you an idea of how the space has really kind of evolved, in the last couple of years, we've seen pretty consistently roughly around $2 billion in inflows into ESG products. And in 2019, we saw $10 billion. So really, the flows in ETFs has really jumped fivefold into the ESG space. We had a couple of, again, going back to what I said earlier, 2 very high profile launches from iShares and Xtrackers. And both of these ETFs, they're ESG focused ETFs based on MSCI indexes, but these ETFs actually seeded with roughly $800 million. Now that is almost unheard of, right? $800 million. And a lot of these are, this was basically a pension fund or an insurance fund, over in Scandinavia, right? Some Finnish insurance companies basically seeded these firms with $800 million. So you're really kind of seeing that kind of insurance and pension funds really start to focus on these types of strategies. And also we're seeing new filings daily. So expect to see a lot more ESG and socially conscious ETFs launch in 2020. And then the one final takeaway on the ESG front, up until this year, most of the assets and flows that we had seen kind of at the top of that list have previously been theme-based strategies, right? Water, solar, alternative energy. Those have kind of been, kind of the larger funds in the category, with the kind of ESG type strategies not really producing much in terms of flows. And this year it's really flopped. The biggest inflows, the largest funds now are full out, ESG focused strategies. Some of them are now, close to 2 billion in AUM. So we've really had that kind of a flip where people are now focused really on that ESG. So again, ESG has been we've seen some huge movements there. So with that said, now I'm going to dive into the assets and flows and kind of go over the highlights here. Just as you can see in the notables for 2019, this year was ETF, again, another banner year, second largest inflows in the history of ETFs with over 333 billion. Again, this year, I think kind of the big standout is fixed income. We've really seen some tremendous flows into the fixed income space. And it's really rare that fixed income, I think, leads U.S. equities in inflows. But this year, fixed income was pretty much dominating flows all the way until December, really. And December, really, equities had this kind of big comeback, which barely nudged U.S. equities over fixed income in flows. But nonetheless, I think this year, the king of flows really goes to fixed income. So again, these are notables in December. I won't go through every single one of these because we already covered 2019. But every month we will have highlights from December. And as I mentioned earlier, you're going to see some newcomers into the space. Allianz now is launching new ETFs. And you're starting to see some more active factor ETFs as well. So here you're basically going to get a chart of assets and flows. As you can see, ETFs, the industry made all-time highs, closed out 2019, all-time highs, total AUM at 4.4 trillion. You're going to basically see the flows over the past 12 months. And again, you can see 2019, we've had some really strong flows with the exception of a couple of months. May and August, we've had positive inflows pretty much throughout the entire year. Here, again, a top 20 leaderboard. This is kind of like a league table of who are the top ETF issuers out there, what their flows have been, as well as total assets. As you can see in the far right corner, far right column, Vanguard and BlackRock this year pretty much stole the show. They dominated flows, both of them over 100 billion in inflows. But some other notables, Schwab were fifth in terms of total AUM, but over the past couple of years, we've consistently been third or fourth in total inflows. And State Street, a couple of things to note here. State Street, their flows a lot of times are largely dependent on SPY, the Spider S&P 500 ETF, which is, I'm sure many of you have all heard that ticker. But their flows tend to whipsaw back and forth depending on SPY. So again, State Street up until December didn't really have much in the ways of inflows, but SPY had a good December, and State Street kind of made a comeback. And Invesco, something a little similar to Spiders in terms of QQQ, the Nasdaq 100 ETF. That's their largest ETF, and their flows can sometimes get whipsawed depending on how the tech sector is doing. But nonetheless, Invesco, powerhouse, they're number 4, Schwab is number 5, and then so on down the list. So this will give you an asset class snapshot. Again, asset classes are broken down into various categories like U.S. equity, international equity, commodities, U.S. fixed income, and whatnot. Again, this will give you a snapshot every month in terms of how the flows are into these asset classes, as well as year to date. And as you can see here, U.S. equity and U.S. fixed income were the two that really kind of brought in a tremendous amount of assets. They dominated flows this year. But I think if you exclude December and kind of that rally in the December equities, fixed income, again, really stole the show, right? And that's not that unusual or surprising, being that we saw some Fed rate cuts this year and interest rates coming down. And then here you're going to see the top 10 net flows of ETFs. Again, as I mentioned, and the top also 10 tickers by outflows. As I mentioned earlier, in terms of who's dominating, as you can see in the top 10 net inflows, the top 10 flows, you can see the whole board is dominated by Vanguard and BlackRock, right? And one of the themes also I want to mention is, as you can see here, as much as you've seen so much, you're seeing, all of us currently are seeing so much in terms of media attention on all these theme-based products and multi-factor strategic beta, but when you really look at the inflows, predominantly all the flows are still going to core cap-weighted equity, right? With the exception here of USMV, which is a min-vol strategy as low volatility. I'm going to dive into that in the strategic beta tracker shortly, but low vol type strategies have really caught on this year. So you're seeing that up there, but beyond that, it's basically core ultra low cost products based on equities and fixed income. And in the top 10 outflows, you're seeing one of the bigger trends here is you're really starting to see kind of a migration from these legacy higher priced ETFs going into kind of the low cost core. And what's interesting here is, number one, you'll see EFA. Now, EFA is kind of a legacy EFA product that MSCI has. It charges quite a bit in terms of expense ratio. But yet, if you look at the inflows, IEFA, which is practically the same strategy, iShares launched a lower cost version of this kind of for the retail audience. You can see that it's the fourth in the most inflows. So again, you're seeing kind of a migration from these kind of larger, very legacy type products that are still priced very high into these low cost products. And you'll see that in EEM again, in the top 10 outflows, you'll see EEM on that list, roughly $3 billion in outflows. But iShares is a retail low cost version, IEMG, actually saw $5 billion in inflows. So again, that's another example. So that's something that's kind of been consistent over the last several years, where we're seeing that migration. Why pay 50 basis points when you can pay say 7 or 8 basis points for practically the same product? And now that liquidity and spreads have tightened on a lot of these retail low cost products. So that's again, not a surprise there. New launches. So every month we're going to list all the new launches so that you can stay on top of some of, sometimes you'll see like a high profile launch and some new issuers entering the space. I'm not going to go through each one of these for December, but these are the new launches in December. And as you can see, you've had some, again, ESG, PIMCO and RAFI teamed up to launch an ESG product and whatnot. So again, this will highlight the new launches. And then again, we'll dive into new filings. Again, you'll see new filings are somewhat interesting to track as well, because you'll kind of get an idea of what types of ETFs are going to be launched and some of the new issuers that are coming into the market. Again, I mentioned earlier, Allianz is now entering the ETF space. And a couple months ago, T. Rowe has now filed for some non-transparent active ETFs. So you're going to start to see some ETFs from T. Rowe Price. Again, these are new filings continued. And as you can imagine, lots of ETF filings. Announced closures. So here we're going to talk about one of the big themes as well is, obviously with all this proliferation in ETFs, a lot of them aren't going to survive. So you're starting to see a lot of closures as well. So here you're going to start to see a lot of the closures that have been announced for that month. And this is a good one to show because in December, Invesco, they announced the closure of a number of ETFs. I believe it was somewhere, the count was over 30 ETFs that they announced that they're going to close. And a lot of this really has to do with consolidating their lineup from their acquisition of Guggenheim. So what they've done is Invesco and Guggenheim recently, or Invesco recently acquired Guggenheim and Guggenheim ETFs. And what they're doing is a lot of these strategies where there's overlap, whatnot, they kind of went through and they're consolidating and they're shuttering a lot of these types of ETFs. Product changes. So here's, you're going to see anytime a notable issuer cuts expense ratios. So for example, we expect Vanguard to cut expense ratios in 2020. We'll highlight that here. Any kind of index changes, again, Spider Portfolio, they've decided to change indexes as well. So you'll see that here, and you can stay on top of that in the product changes section. So that's basically the ETF highlights at a glance. Again, this is meant to be kind of a simple overview. So hopefully you'll get a lot of information out of this and not have to spend a lot of time reading or searching the internet for fragmented news here and there. So next, I'm going to dive into the strategic beta highlights. This is actually one of my favorite reports, and the reason being is because when you look at flows into strategic beta, it really gives you a good idea of where the money is going, right, in the markets in terms of what types of strategies. Is there a rotation from growth to value? Are people buying into low volatility? Are people buying into quality attributes and whatnot? So I find this to be really interesting. And again, we produce this on a quarterly basis. And notables this quarter and for the year, strategic beta, just to go over some assets and flows, strategic beta for the first time, it's nearing 1 billion. So again, we've had some really strong flows into strategic beta. The AUM at 1 billion, that's a new record high. And we've also seen the largest strategic beta inflows on record, roughly 75 billion in 2019. As well as some of these other notables here. Some of these are based on flow, so I'm going to just dive into the report here. Similar to the format's going to be similar to the ETF highlights, but again, this will specifically only focus on strategic beta, ETFs and issuers. And by strategic beta, for some of you who may be wondering, according to whose definition of strategic beta, sometimes strategic beta and how a fund is classified as strategic beta can be somewhat subjective. So we use Morningstar's strategic beta taxonomy. We believe that Morningstar has done a good job of kind of categorizing all the different strategic beta categories out there and assigning strategic beta categories to each fund. So this is, again, according to Morningstar. But according to Morningstar, again, you'll see this asset flow chart. You'll see, obviously, assets are kind of increasing in strategic beta, and flows, very strong flows, with the exception of July and January. We've had some pretty strong flows into strategic beta ETFs in 2019. Again, this is going to be the strategic beta ETF leaderboard. These are issuers that have strategic beta ETFs. Once again, Vanguard and BlackRock dominate. But then again, you see some changes. Another big player in the strategic beta space is Invesco. And then Schwab with our fundamental index lineup. We also have some pretty strong flows into strategic beta as well. And then you go down the list, some of these big names that you'll probably realize in the strategic beta space, WisdomTree with all their dividend-weighted strategies, Goldman Sachs. Goldman Sachs has recently been making some pretty big movements in the multi-factor space. And then you also have Flex Shares and so on down the list. So this will give you an idea of kind of issuers in terms of who's doing well in the strategic beta landscape and what their assets and flows are like. So this next slide is kind of for me, being kind of the ETF guy that I am and being really into the space. This is kind of like what I would call like the money slide, right, for strategic beta, because what this does is in one snapshot, it gives you a comprehensive picture of what types of strategies. First of all, it breaks down all the strategic beta landscape into all these different categories, but also gives you an idea of where really the flows are going. Where's the interest? And as you can see here, in 2019, far right column again, year to date, the attributes that have really dominated is dividend strategies, low volatility, and quality, if you go down the list there. And in Q4, value strategies have really made a comeback as people are starting to kind of hunt for value, as a lot of folks are starting to believe that valuations are stretched in the market. So again, these are kind of like the key trends. And what I find interesting too is it actually makes perfect sense. When you look at a lot of factors that have done well historically, oftentimes in kind of the late expansionary phase, which I think most of us would agree that we're somewhat in a late expansion phase, the attributes that do really well, or where a lot of the interest is, happens to be dividend, low volatility, and quality. Those are three factors that tend to do well in kind of a late expansionary phase. And also in a late expansionary phase, momentum historically has kind of done well, right? As everyone's trying to ride that momentum However, what's really interesting is in 2019, or actually towards the end of the year, momentum really fell out of favor. You can see that momentum had about 1.1 billion in outflows year to date, but in the fourth quarter alone, you're seeing 1.5 billion. So predominantly, all the outflows have come out of momentum in the last quarter of last year. And then again, getting back to dividend, low volatility, and quality, those also tend to be attributes that are favored in an early contraction phase as well. So again, you can kind of see where that's playing out here if you look at the flows. Some other flows that I like looking at, obviously, multi-factor did really well in 2019. But again, really interesting kind of see this because, again, it gives you kind of a comprehensive picture of kind of what's happening in the markets, where the money is going, and where some of the trends might be. Again, similar to what I showed in the ETF highlights, we also have the top 10 net flows for the quarter, as well as year to date. And since it's December, why don't we focus on all of 2019? Again, if you look at the top 10 net inflows, you'll see that a lot of dividend and low volatility strategies have pulled in a lot of assets as well as quality. USMV is really kind of the rock star here, I think, of 2019. That fund has done just incredible inflows into that fund, as well as QUAL, iShares' quality product. And again, you're going down the dividend list. Now, when you go in the top 10 outflows, though, again, what's kind of interesting is on the biggest outflows is you're seeing them in some of these kind of legacy products once again, right? iShares, Russell 1000, Value and Growth, those funds have been around forever. And those are kind of still kind of the higher priced legacy products, and you're starting to see outflows from those products likely going into some of these kind of lower cost products, more focused on the retail space. And then obviously, if you go down the list here, you're going to start to see some outflows into, again, another legacy DVY. Even though dividends are really hot, DVY is a very higher price legacy product. You're starting to see outflows there, roughly 900 million in outflows. So here, I think for those of you who are kind of interested in kind of seeing where in strategic beta, so what are some of the largest assets based on all these categories, this will basically break down the largest ETF tickers by assets under management in each of these categories. So as you can see in the dividend space, you'll see that Vanguard has the two largest ETFs and so on down the list. In the value space, you'll see, which funds are kind of the largest funds. I'm not going to go through each one of these, but obviously then you got growth, risk-oriented. Risk-oriented is low volatility, basically, strategies, and that's just the name that Morningstar has given that category. But that's where you'll find funds like USMV and some of these other popular tickers like SPLV, the Invesco S&P Low Volatility ETF. And then the multi-factor space, again, the standout here is Goldman Sachs. They're kind of, in terms of size, they're about 7.5 billion, so that's kind of like the largest multi-factor ETF out there. Fundamentals, that's going to be dominated by Schwab and Invesco. As many of you probably know, Schwab also has research affiliates, RAFI index products, so that's where a lot of the fundamental products will fall under in that category. And then groups by assets. Other is predominantly dominated by equal weight. You'll see RSP there. That's the S&P equal weight strategy. That's kind of been kind of the go-to fund for a lot of people looking at equal weight strategies. You got quality, momentum, and fixed income. Strategic beta fixed income has generated a lot of interest recently, but they haven't gotten mainstream enough, we believe, for Morningstar to kind of break that category apart. So right now, any strategy that's considered strategic beta, non-cap weighted or factor-based strategies falls into this fixed income bucket here in terms of strategic beta. And then, of course, same goes with commodities as well. And again, similar to the ETF highlights, we got new launches that we'll highlight every quarter. This will give you an idea of what type of proliferation you're seeing based on strategy. In the past, we've really been seeing a tremendous amount of proliferation in the multi-factor space, to the point where even if you're in the industry and you're tracking this stuff, it's actually becoming very, very difficult to kind of stay on top of, because there's so many of these multi-factor ETFs that are launching out there. And then also fund closures. What types of strategies are closing out there? And you'll get the definitions for those of you who want to know how Morningstar is classifying each one of these categories here. So that's just a brief overview of the ETF highlights and the strategic beta trackers. At this point, I'm going to turn things over to Tyson. I know Tyson has a few comments that he wanted made in terms of some conversations that he's been having with some members on your team, and some of the things that maybe, and I'll follow up and discuss some of those key trends and themes. So Tyson, I'll turn things over to you.
Okay, thank you, Dennis. Thank you, everybody, for allowing Dennis and I to participate on the call. Tina specifically for coordinating. Just wanted to mention a few things that maybe help tie together both reports that Dennis had mentioned. You saw our fundamental index suite on there. That is approved at Securities America, even all the way up to Ladenburg Thalmann. We actually even have the international small company version of that ETF on the Ladenburg Thalmann recommended list. Each of the fundamental index strategies is managed the exact same way. We're just looking at sales, cash flow, dividends, and buybacks, averaging those over the prior 5 years. That's what we're buying, that's what we're trimming from the portfolio. So it fits into a couple of those strategic beta boxes that are garnering a lot of flows right now. And because of those three characteristics, we have a huge tilt towards value. A couple other ones that are already being implemented with Securities America, specifically U.S. advisors with Tina and Jillian. SCHD is our dividend equity strategy. I think Dennis has a couple resources to show you as well, but we're way overweight quality, yield, and value with that one. That actually might be U.S. advisors' largest holding with us. And another one that we think is a very trendy category to be looking at is tips. You're not going to be looking at an overvalued category as you are in a lot of the equity markets, so it's an easy transition over. And we manage our tip product similar to a lot of the other strategies, but as with most things Schwab ETF related, we have a bit of a cost benefit there. And I think Dennis has a one-pager on that. So before I go through anything else, I think, Dennis, if you want to maybe pull up the factor pieces or the one-pagers for SCHD and SCHP, we can kind of use those to tie in some of the highlights of some of the reports and see how one might use those report to look, one of those reports to look at a specific ETF.
Sure. Yeah. Thank you, Tyson. So getting back to what I talked about in terms of flows for strategic beta, as you recall, I had mentioned that some of the key kind of attributes that are very popular right now is dividend or yield, quality, low volatility, and we've seen kind of towards the end of the year heightened interest in value. And this here is something that we currently have access to. We've recently partnered with MSCI, and what MSCI has done is they've developed what they call the factor box. And we love this because this basically what it does is if you plug in a ticker, it basically gives you the exposures and the magnitude of the exposures that fund is providing to the investor. So here, as you can see, SCHD, or Schwab Dividend, that is the dark blue, the navy blue there. You'll see this huge overweight to yield, quality, and you also have this overweight to value as well. And at the same time, you have a huge underweight to the growth factor. And why is that important? Because just so that you can compare what this product gives you exposure to compared to the S&P 500, and in this case we're using SPY as a proxy for the S&P 500, you'll get a good sense of what the exposure differences are against the S&P 500. And again, what you're seeing here is basically, even if you own the S&P 500 or the broad U.S. stock market, it's really, SCHD can work as a real nice complement in terms of the exposures that you're getting, right? Again, the negative growth, the enhanced exposure to value, quality, and yield. So even on the momentum side, you're starting, a lot of, as many of you can probably imagine, with the markets, at 52-week highs, they tend to have a momentum tilt to it, and some of these strategies can kind of offset that. So again, this is a partnership with MSCI, and this is something that we love looking at because a picture's worth 1,000 words, and it's very easy and simple to kind of look at and understand the various exposures that you're getting here. And as Tyson mentioned, we do have a couple of collateral pieces here. Again, this is basically kind of an overview of SCHD, but why SCHD, why it resonates with so many people. What are kind of the key takeaways if you can take away 3 things from the fund. Again, SCHD not only searches for seeks high yield, but it actually also focuses on the quality of those yields, which is really important too. So again, that's where you're kind of getting that yield and quality exposure. It'll tell you kind of the quality screens here, cash flow to total debt, return on equity, dividend yield, 5-year dividend growth rate. And then if you go down here, you'll see that factor box that I just mentioned, and you'll see the comparisons against, this is the US broad market ETF, but again, the broad market ETFs, the exposures are somewhat similar to US large cap, what I just showed with SPY. So you can get a good comparison there. The other factor box that I did want to share is our factor box for a fundamental suite. So as Tyson mentioned, fundamental, we currently have a lot of white papers that talk about combining fundamental with cap weight. And this is where, when you plug it into the factor box, you can really see how how combining fundamental with cap weight gives you that diversification. As you can see here, fundamental index tends to have a large overweight to value, as well as yield too. So that's less talked about, but being that one of the screeners for the RAFI fundamental index is dividends plus buybacks, you get this kind of bump up in yield as well. So again, as you can see here, complementary exposures to cap weight, and you got that huge negative growth exposure as well. And one of the factor boxes that I wanted to share is in the emerging market space. Some of you may have read that, but the dispersion between growth and value is somewhat extreme in emerging markets. And here you can really kind of see how when you blend the Schwab Fundamental Emerging Markets ETF with a cap weight ETF like SCHE, but obviously that could even be a good proxy for the Vanguard Emerging Markets ETF, ticker VWO, or iShares EM ETF, IEMG. You're getting these really complementary exposures, this huge overweight to value, yield, but then with the fundamental side, you're getting an overweight to quality. And if you look at the cap weighted side, this is kind of what you want, right? You want any kind of fund that you're blending together with cap weight, you're doing that for the sake of diversification, and you want that factor diversity, and this is what you're really getting here, right? With the negative or the underweight to yield and low volatility and quality and value that you're getting with the cap weighted emerging markets ETF versus what you're getting with the fundamental ETF. And again, I'm going to just share a couple things that I find that you might find interesting here. You'll see this factor box. Tyson can share this collateral with you here after the call. But here's a collateral piece that we have on fundamental, talking about the benefits of blending the strategies. You'll see kind of this factor box that I just mentioned, but not just in terms of factors, but also in terms of holdings and sectors as well. As you can see, FANG exposure, right? You get a heavy FANG exposure to a lot of these tech companies with U.S. broad companies like, or broad indices like the S&P 500. Fundamental index tends to weight companies by their economic footprint and their fundamental size. So again, you're going to get in that reduced exposure to the FANGs. You're going to get more exposure to energy and less exposure to tech, as you can see on the bottom. And again, in the emerging market space, this is even more extreme because what you're getting is, some of you may have heard the acronym BAT. Those are the three kind of tech internet giants from China: Baidu, Alibaba, Tencent. A lot of these emerging markets cap-weighted ETFs are heavily weighted in the BATs and beyond some of these Chinese tech companies. And what you're going to get is you're going to get significantly reduced exposure to the BATs with the fundamental EM ETF, as well as more exposure to some commodity producing countries like Russia and Brazil compared to cap weighted. So those are kind of some key, I think, collateral pieces that we have that we think you might find very interesting, especially being that SCHD is something that your firm has already kind of looked into and is a holder of. I think you'll find the factor box very interesting to look at. So Tyson, I'm going to turn things over to you again. I know you have some closing remarks, and I know there may be some questions.
Yeah. At this time, I think we'll open it up for any questions, and then after that, I'll kind of tie everything together and discuss what I'll be sending as a follow up. So, Tina, is there any questions in the queue there?
Hi, thank you so much. So one question that we've got, when you talk about ESG, which is environmental, social governance, it's kind of hard to gauge companies on their governance. It's kind of a anomaly. Is there any easy way for us to track that, either like through Morningstar or any kind of reporting that you do to see what companies are, being forthright with how they're governing?
Yes, yeah, that's a great question, and it kind of ties back to kind of the bigger issue with ESG and that is, it's really hard to create a product for a one-size-fits-all, right? When it comes to ESG, a lot of folks want different things, right? Some people are more, they have a stronger preference towards excluding, oil companies. Some people are more into governance, and everyone kind of wants different things. So it kind of ties into that, and it is. You're right. That's a really great question. It's difficult, and in some ways, it's subjective too, right? Depending on what you're looking at in terms of, what is the criteria for environmental, what is the criteria for social that this data provider is looking at in order to produce that type of score. It is going to be subjective. But currently at Schwab, we don't have like an ESG screener. But for the listeners on the call, MSCI and Morningstar have done a lot of work in terms of ESG. Morningstar made an acquisition with Sustainalytics, and MSCI has been doing ESG kind of analysis for years now. And both MSCI and Morningstar, for some of you, if you have Morningstar Direct, there are ESG kind of scores where you can pull up a ticker or a fund and kind of take a look at what type of ESG scores they have and how it's broken down. And for those of you who may not have access to Morningstar Direct, a really good resource is actually ETF.com, right? This is where I formerly came from, but ETF.com, currently, if you go on ETF.com, if you type in ETF.com/ticker, any ticker, so do ETF.com/SPY, ETF.com/EEM, you're going to get a fund report. And in that fund report, ETF.com now actually has the ESG ratings on there from MSCI. So let me I'll just show you really quick what I'm talking about here. Here we go. Let's see. So ETF.com/ let's just do EEM. So if you scroll down here, you're going to see the MSCI ratings for EEM here, and it'll tell you kind of a little bit what that means here. And the other thing I wanted to mention too is the MSCI factor box. So ETF.com recently added that as well. So if you want to see the factor exposures for various tickers, this is also a good place to come. And the great thing about this is ETF.com, the website's free. So I still go to ETF.com every single day, and it's a great resource for someone who wants to get some insights into these types of analysis.
Right, that's a perfect resource to use, and like you said, it's free and it's accessible to everybody, so that's a great tip. Another question, and something that we've been seeing maybe as a trend, especially with market highs and number-breaking records, will value outperform going forward versus growth? And you've showed us, with those boxes that value is in favor. Anything you could recommend on the Schwab side or other positions for value?
Yeah, that's kind of an. Oh, go ahead, Tyson. Go ahead.
Oh, yeah, I was just going to mention anything with fundamental index is going to have a huge tilt towards value. It's been around a lot longer than some of these kind of niche strategic beta strategies. 13 years actually, in the as an index mutual fund, and it'll be 7 this year as an ETF. Because of the factors we use, cash flow, dividends, and sales, you can implement those to any country in the world. And so we use the same philosophy, whether it's U.S. large, U.S. small, international large, small, or EM, and you can pair that up with your cap weighted stuff that's more growth and momentum weighted. And then the other one that has, to kind of bring that back home, fundamental index has a large value tilt. We also have on the cap weighted side, SCHB, which is our 5 basis point cap weighted ETF. Just looking at price times outstanding shares. And then SCHD, the U.S. advisor's largest holding with us, that has a large tilt towards value as well. And you pick up a pretty nice income as well. It's about 3.25%, maybe closer to 3% right now on the quarterly dividend yield. So that'll be part of my follow-up, as I'll include both the reports that Dennis covered, as well as some of our themes that fit into where we have a lot of conviction as far as where we think advisors and clients should be looking for 2020, along with some of our other value adds, behavioral finance, ETF education. That'll all be a part of the follow-up email that I send out to everybody.
That would be great, Tyson. And then as well, if you could include the new income funds.
Absolutely. Yes, ma'am.
Mm-hmm. Yeah, and then another question that had come up, more specifically kind of drilling down into a specific sector, would be oil and gas or precious metals like gold and silver. Any insight on that you could share?
So in terms of those types of energy companies, one of the things that I'd point out is, because of the way fundamental index is constructed, obviously Schwab doesn't have, we're kind of we're focused on core kind of foundational products. We don't have sector specific funds. So we don't have any, energy products or anything like that. But fundamental index, because of the way it's constructed, I think I'd pulled up, let me pull this up again for FNDX. So because of the way it screens for cash flow, sales, and dividends plus buybacks, what you're getting is you're actually going to get a heavier exposure kind of to energy, right? And that's where pairing it up with Capway can give you that increased exposure to those types of sectors. And in terms of like the emerging markets, right? I mentioned earlier, kind of more of those commodity producing countries are going to get a little bit more weight, right? And so again, I think the bigger takeaway here also is, and this goes back to kind of like that value question that you asked before. It's really difficult, right? It's easy to look at flows and you can see where the flows are going, and clearly investors are starting to kind of brace for somewhat maybe a rotation from growth to value, or maybe they just want value because they're top heavy in growth and momentum. But I think the bigger takeaway here is to kind of just be diversified, right? Because if you only hold cap weighted, and that's all you hold in your portfolio, you may be top heavy or overweight in growthier or momentum type stocks. And that's where something like fundamental index can pair that back a little bit with that, increased exposure to energy and whatnot. And in terms of, whether you want to select, for the advisors on the call, this is just as me talking as an ETF analyst. When you're buying a commodity products, really the question is are you going to buy commodity producing stock, right? Stock funds, where you're buying, company stocks that hold, or ETFs that hold companies like, ExxonMobil, BHP, Billiton, and whatnot, or are you going to go the commodity route where you're buying, commodity pools, right? Some of these ETFs now, they hold futures contracts, and they do have to roll those futures contracts over. So I would just have folks keep in mind that those are very different strategies, and some commodity pool ETFs, being that they're structured as commodity pools and they are viewed as the IRS sees them as limited partnerships, they will distribute K1s. So some things just to keep in mind.
Yeah, that's a very good point, especially when tax time rolls around and they're having to pay things that maybe they're not familiar with. So great. I think that's all the questions I have. If there's anyone else that has questions, if you want to enter in the chat box, we can do that now. Otherwise, they can always take questions offline. I know we're coming up to the end of our hour, and thank you everyone for participating, and thank you to both Tyson and Dennis for all your insight and highlights of the year to come. For advisors on the call, I would ask you for a call to action. Please review with your clients retiring in the next year to two. Considering the expenses they're paying now, does it make sense to switch more into ETFs? And then, of course, featuring the income side of the portfolio, how are you going to build that out going forward? So best to you all in this new year. Looking forward to calls in the future. Any questions or concerns you have my email. Please feel free to reach out. And again, thank you to Tyson and Dennis for the call today.
Thanks for allowing us to participate. Have a great day, everybody.
Thank you.
Thank you so much.